5 minutes. That is all you need to analyze any mutual fund and know whether it's right for you and your portfolio. Today, I'm going to share an analysis of a mutual fund live with you step by step using a framework that I have built called Flash, where F stands for fundamentals, L for long-term returns, A for approach and allocation, then S for stress and stability, and finally H for how it fits your portfolio. This framework cuts through all noise and filters out bad funds from good ones. And in this video, I'm going to put the flash on the ICICI Prudential Value Fund. This is one of the oldest funds in India. It was launched in 2004 and a real 5,000 per month SIP in it across this entire tenure with a 5% annual step up would have grown to 2.4 crores in 21 years. Hello everyone, I'm Udayan Adhe and I've been licensed in Indian financial services since 2015, and so far I've helped over 2,000 families make better financial decisions, and here on my YouTube channel I talk about all things money and personal development. So let's start off with F for fundamentals, right? So this tells you what a fund is and whether you should even consider it in the first place based on several parameters. Firstly, a lot of hints lie in the fund's name. So to quickly analyze this, just Google the fund's name and follow that up with a website name called Value Research. The moment you do that, just go to the first link available, which is the Value Research online link, and you'll go to the funds page. Here, focus on a few things. Firstly, category, right, which is equity, which means this fund is investing in stocks. That's number one. Number two, value oriented, which is also apparent in the name, right? Value fund. And the category then becomes value oriented. If you're not able to make it out, just use Value Research and this fund page. So we understand what value oriented or value types of funds are as we go along, but keep that in mind. Now, the first filter here is if you're investing for any period less than 5 years, then you should not even consider equity funds because they're too volatile in the short run. If you invest in them, the markets don't do well. You may end up not getting good returns or even end up losing money. But if you're staying invested for, let's say, 5 years, the odds of getting decent returns go higher. The longer this is, the better. In fact, if you were to personally ask me and really put me on the spot, for any money that I am investing for less than 7 years, I would not put 100% of that in the stock market. I would always split it between the markets and safer assets together. So that's step number one. Secondly, we want to check the credibility of who is floating this fund, right? Which is ICICI Prudential. So we all know ICICI is a big brand, but we still want to do our due diligence, right? And for that, we will use AI, and I've used Perplexity with all of you in the past. The prompt that I'm going to share on and use on Perplexity is also available in the description. All you have to do is basically swap out the fund name. Here I'm analyzing the value fund from ICICI, so I've put that name. If you're analyzing a different fund, just put that name. The moment I press send, right, Perplexity will take a few seconds, maybe a minute at the most, and it will quickly analyze everything that I want to know in one go. So firstly, AMC credibility, right? It says it is one of India's, it's an industry leading AMC backed by ICICI Bank, manages a lot of money, right? To almost 12.5 lakh crores. Then at the same time, you can see here that the fund management underwent a change in 2021, which is something that we want to be aware of and we want to use that as we go along. Investing style, this becomes especially important. I'll share with you what value style of investing is, but when we get to A for approach and allocation, it becomes specifically important. So investing style, value style here basically means the fund house and the fund manager is trying to find undervalued stocks. So they would not focus on companies that are growing very fast but are not able to make much profit, or the valuation of that company is too high and the price just does not justify, or the market valuation just does not justify how much revenue and profit the company is making. It is a very simplistic definition of value style of investing. But the other style of investing, right, like let's say momentum style, they don't care about revenue growth. All they care about is the price, and price dictates everything. Whereas value style is very different, right? It takes into account multiple things. It's not as if one investing style is always better than the other. That's why you always want to have a mix. More on that later as we go through the flash analysis. But firstly, is this AMC credible? Yes, it is, right? It's a big name. Then it underwent a fund management change, right? So we want to investigate that a little more. For that, we'll go to Value Research once again. I'll go to Other, and this will tell me who the fund managers are right now, right? So if I go down the list, you'll see right away that in 2021 January, a new fund manager came in, Dharmesh Kakkad. The fund management underwent a change in 2021, and we want to make sure that when the fund manager changed, how the fund performed after that. Because if the fund did not do well, then there's something that has gone wrong. So then we ideally don't even want to consider this fund, right? It doesn't qualify. The fundamentals don't check out. So as we get to L for long-term returns, we'll keep an eye out on that. But from the first standpoint, everything seems to be clear. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. So now let's move on to L for long-term returns. And here I see a lot of people making the mistake of just looking at CAGR or compounded annual growth rate. Or they just go to websites like, let's say, Value Research, Money Control, or other websites like it, and just filter funds as per 1 year returns and invest in the funds that have done well in the past 1 year. That's a very flawed approach, because the funds that have done well in the past 3 years are less likely to do well in the following 3 years. In fact, 3/4 of the funds that continue to be that have been at the top, they don't be at the top in the next 3 years. An excellent Funds India study, which I have always referred to if you've been a friend of the channel. So looking at CAGR or trailing returns is absolutely flawed. What we want to focus on is rolling returns. I'll quickly share why rolling returns are important and the metric to look at. So let's say you're looking at rolling returns over the past 10 years and you're looking at 5-year rolling returns. So from 1st September 2015 to 1st September 2020, 2nd September 2015 to 2nd September 2020, and so on, right? So it'll look at so many dates, it'll look at so many calculations, and it'll average it out. So you get a great idea of a fund's consistency. Now I know this may seem very complicated to calculate yourself, but good news, you don't have to calculate it yourself. There are free websites that do this. One of them, Advisor Coach, is linked in the description. Right now I'm in DSP Portfolio Create and I've got the ICICI Prudential Value Fund here, right? The moment I click on ICICI Prudential Value Discovery Fund and you see that the line gets highlighted a bit more, you will realize that there was a period between the start of 2017 till about the end of 2020 when the fund did not do well. If you see the other two lines, they have always been under it except for that window. Now here you will see the Nifty 500, which I've taken as the benchmark because the value fund technically is not obliged to invest only in large cap, mid cap or small cap. It can invest anywhere as long as it's following the value style of investing. I've also taken the category average, which is all the equity value funds that are out there, an average of that, and that is represented by this line that is highlighted right now. Again, the value fund, as I said, has always performed better except for that small window. From a rolling returns perspective, and these are rolling returns, right? So if I just hover my mouse over any one point, you will see it's that 5-year window, and if I move my mouse to the next point, it's the next 5-year window. If this was trailing returns on the other hand, right, if I just press trailing returns, you will see that it's only capturing one data point and how the fund did before that. So it can be a flawed metric because if the fund has one great year, one bad year, it can skew the returns. Let's go back to rolling returns. Let's look at the median rolling returns that the ICICI Prudential Value Fund has generated, which is 20.1%. which is extremely high, right? Generally as well, but in comparison to the Nifty 500 and also equity value as a category, which is 17%. Then even with respect to the standard deviation, you will see that the value fund in a way, yes, has a higher standard deviation from Nifty 500, but that wouldn't be the fairest of the comparisons, right? You want to look at the peers. Whereas if you look at equity value as a category, it's 6.78, which is, I'll take that every day, right? I'm getting 3.1% extra returns every single year on average, and why not do that? One more fascinating stat is how many times has this fund given over 20% annual returns across a 5-year window, and it is a staggering 51% of the time. So Again, L becomes a big victory. So now with the fund management change, right? The new fund manager came in about Jan 2021. So let's just look at how the performance has moved from January onwards. You will see right away, right? The fund manager came in and the fund started doing well. Now it isn't as if the fund manager was the only reason or is always the only reason a fund is not doing well. Not at all. At times, certain circumstances, right? The economy, what is happening with commodities, with currency, all of that plays a role in what type or what style of investing is working at that point. So the moment COVID happened, a lot of commodity prices, they were going down for a long time, they started going up. And that's when all these stocks that had been lapped up by value oriented funds, they started doing well, because for a long time they were out of fashion, and then they suddenly started going up and they captured that up move. And that ticks off F for fundamentals as well for us. So this is the classic example, right? You don't forget about just one factor because you've ticked it off. They all are working together, and you have to look at the Flash framework as a whole and not just as 5 different parts. Okay, then comes A for approach and allocation. Now here you want to figure out what is exactly happening inside the fund. So where is it investing? And for that, I'm going to go to ET Money, which provides, I think, the best analysis of this. So firstly, you will see asset allocation. So 92% of the money gets invested in stocks, right? So this is great because that's what it's meant to do. Then top holdings, right? Just look at this. Reliance Industries, ICICI Bank, HDFC Bank, Infosys, right? All the biggest companies which is in sync with the fund investing majority of its money in large cap stocks. Now what is interesting that I want you to focus on is, and this becomes very important when you're selecting funds like this, is you want to see what is the spread across large, mid and small caps. So here you will see most of the money, right? So out of 100 rupees that the fund is investing, almost 82% is going into large cap stocks, which is huge. So essentially it can invest across different categories, but the fund management and the manager, they're choosing to invest in large cap stocks. So as we move forward to H for how it fits your portfolio, you need to keep that in mind. And I'll tell you why that becomes important and how it can fit your portfolio, whether it can fit your portfolio. Now, when you're building a mutual fund portfolio, you want to ensure that you're spreading your money across large cap, mid cap and small cap funds. But not just that, but you also want to diversify across investing styles. So that is the growth style, momentum style and value style. So a fund like this becomes extremely interesting, right? Because it can be the potential value exposure that you get in your portfolio. Now let's move on to the S in our Flash framework, where S stands for stress and stability. This is all about how a fund behaves when the markets are not doing well or when they're doing exceedingly well. One very useful metric that captures all of this is called a capture ratio. And there are 3 types of capture ratios. First is upmarket capture ratio, second is downmarket, and third is total capture ratio. And all 3 are essential. So let me break this down very easily with an example. So let's say in the case of the ICICI Prudential Value Fund, the BSE 500 goes up by 10% in 1 year, but the ICICI Prudential Value Fund goes up by 15%. So that means the market has gone up by 10, this fund by 15. So when the markets are going up, this fund has actually done better than the market as a whole, which is great, right? Because that's what we want. So the upmarket capture ratio of this particular fund would be 15% divided by 10%, which is 150%. So it captured 150% of the up move, which is great. Similarly, the down market capture ratio calculates how much of the falling market's move was absorbed by this fund. So let's say the Nifty 500 went down by minus 10% in 1 year, whereas the ICICI Prudential Value Fund only went down by 5%. Now in this case, this is again exactly the place we want to be in, because if the markets are going down, you don't want to fall as much. So in this case, the down market capture ratio is minus 5% divided by minus 10%, which is 50%. So the lower the down market capture ratio, the better. The higher the up market capture ratio, the better. And when you simply divide the up market ratio by the down market capture ratio, you get the total capture ratio. Again, this may seem complicated, but there are websites that do it for you. Again, I've linked Advisor Coach in the description of this video, so check it out. So here I've pitched the ICICI Prudential Value Fund along with other big value funds in India. They've been around for a long time. And just look at the capture ratios, right? You will see the up market capture ratio, the down market capture ratio, and then the total capture ratio. So for ICICI Prudential, you will see the upmarket capture ratio is 96, which is actually lower than its peers, right? So it doesn't capture the entire market movement. it captures only 96% of it. So if the market goes up by 10%, this fund would have gone up by 9.6%, whereas the others have gone up by higher than 10%. But here's where the magic is. In the down market capture ratio, look at this. The ICICI Prudential Value Fund is only at 51. That means if the markets have gone down by 30%, this fund in the past has only gone down by half of that, by around 15%, only when the markets are down 30%. And here's what that does. It absolutely skyrockets the total capture ratio just because the down market capture ratio is so small. And if you compare the fund to its peers, look at the down market capture ratio, very similar, right? Around 90%. So it's capturing almost the entire down market move. And that's why even the total capture ratio for the ICICI Prudential Value Fund is extremely high. Now, when the difference is that apparent, you know there's a clear winner out there. If the difference is not much, if the funds are very close to each other like the others are, right? I wouldn't distinguish between a 1.16 and a 1.26 as much if I had to make a choice. But here you want to check if the fund that you're investing in basically is on track when it comes to capture ratios. And finally, we are now on H for how it fits your portfolio. This is extremely important because remember what I told you earlier? This fund follows the value style of investing. It's mainly investing in large cap stocks. So when you're constructing a mutual fund portfolio, you want to ensure that this is not replicating another fund that you're having in your portfolio. So this could be a great way to, let's say, invest 20% of your money because that gives you large cap exposure and value style of investing. So the value style of investing box gets ticked. Maybe you can have another 10, 20, 30% in a different style of investing fund, which is also investing in large caps. So that means that you've got two complementary styles in the large cap category, and that basically completes your portfolio, right? Because if you're investing in similar kinds of funds, whether they follow the same category allocation, which is, let's say all of them are investing in large cap stocks and they're following the same style of investing. The moment this happens, you may think that you have diversification because you're investing in 3 or 4 different funds, but at the end of the day, you're essentially investing in the same places. And that's why it becomes important to have this diversity across categories and across investing styles. So pairing this up with mid and small cap funds and the growth and momentum style of investing could make your portfolio complete. That's it for me today. If you enjoyed watching this video, then check this one out where I share with you how I would invest 10 lakh rupees right now. In that video, I've shared with you 3 investing strategies, one for beginners, one for moderate risk, and one if you want to be aggressive. And I'll see you in the next one.